In this video, we're going to walk through a financing lease from the lessor's perspective. Assume that IBM has leased equipment that was carried at a cost of $120,000 to Sharon Swandler Company. The term of the lease is 6 years beginning January 1, 2020, with equal rental payments of $28,430 due at the beginning of each year. All executory costs are paid by Swandler directly to third parties. The fair value of the equipment at the inception of the lease is $145,000, and the equipment has a useful life of 6 years with no residual value. The lease has an implicit interest rate of 7%, there's no bargain purchase option, and no transfer of title. Collectability is reasonably assured with no additional cost to be incurred by IBM. Is this a financing lease, and if so, why? Well, we were told it's a financing lease, but let's review this classification criteria. 1. Is there a transfer of ownership? In this case, we were told no. Is there a bargain purchase option? The answer to that is no. The lease term, however, is greater than 75% of the economic life of the asset, and as well as the present value of the lease payments exceeding 90% of the fair market value of the asset. So it is a financing lease. The lease term is equal to 75% or more. We are told the equipment has a useful life of 6 years, and there is a 6-year lease term. In terms of the present value, we can calculate the present value of the future minimum lease payments, and those would equal $145,000. We can do that by taking the payment, multiplying it by the present value annuity factor, and that is greater than, in this case it's equal to, the $145,000 fair market value of the equipment. And again, from the lessor's perspective, IBM's perspective, this is a sales type lease. IBM has essentially sold the equipment to Swandler, and instead of receiving cash, is entering into a financing agreement where IBM will receive $28,430 for 6 periods. And a financing lease should be recorded at the lower of either the fair market value or the present value of the future minimum lease payments. And in this case, both of them are the same thing. We had the present value, future minimum lease payments, $145, fair value of the equipment, $145. Let's go ahead and take a look at IBM's journal entries for 2020 and 2021. At the inception of the lease on January 1, 2020, IBM, of course, will record a lease receivable and sales revenue, and that sales revenue will be equal to the present value of future minimum lease payments, which is $145,000. We can calculate that by taking the payment, multiplying it by the present value of an annuity due factor we were given, or we can use our financial calculator, making sure it's on the annuity due setting. We had 6 payments, a 7% interest rate, a payment of $28,430 per period, and we have 0 for the future value. In this case, recall, we include any excess in the guaranteed residual over the expected residual value of our leased asset in the calculation of our lease liability and rights of use asset. In this case, there is no residual, so that future value is 0. When we solve for the present value, we would have gotten the $145,000. So we record a lease receivable of $145,000 and sales revenue of $145,000. When we make the sale, we also need to record cost of goods sold, which we were told was $120,000, as well as reducing our inventory by $120,000. On January 1, 2020, at the inception of the lease, we're also receiving the first lease payment. And we have, of course, if we're getting a payment of $28,430 and no time has yet passed, we will credit all of that to the principal on the loan. So the loan will go down to $116,570. And again, we are going to credit the lease receivable and debit cash for the amount of the lease payment. We do that every time we receive a lease payment. So again, since we've received a payment at time 0 and there is yet to have any interest revenue earned, the entire amount goes to reduce the lease principal. On December 31st, 2020, we need to record an accrual at year end for interest receivable. We will credit our interest revenue for $8,160 and debit the lease receivable. That's the carrying balance on the loan times 7%. And again, that's the prior period balance of $116,570 times 7%. When we receive our next payment of $28,430, if $8,160 is interest, the difference, of course, will be credited to principal and will reduce the receivable balance to $96,300. And that same process would go on for each one of our lease payments. We're off slightly due to rounding in our amortization table. Come January 1, 2021, it's again time to receive a lease payment, and we will debit cash for $28,430, and as always, we get the cash, we reduce the receivable by $28,430. On December 31st, 2021, once again, we're going to need to record interest revenue. We will debit the lease receivable and credit interest revenue for $6,741. That's the initial lease receivable of $145,000 minus the amounts that have been credited towards principal. So that's 7% times the $96,300. Finally, let's record the receipt of a cash payment on our lease once again, this time on January 1, 2020. We get $28,430 in cash and credit the receivable for $28,430 as well. And again, that entry is on January 1, 2022. On December 31st, 2022, we will again report lease receivable and interest revenue, and those, of course, would simply be picked up from the third period on our amortization table.